am showing 12 on the dot, so I will kick things off and officially welcome you to our 9th session in the 2024 Yellowbook training series. I'm Rachel Windett, and I work with Sikich University here at Sikich, and I'll be on to support you. We also have Rachel Hawley with our marketing team with us. She and I will be screening the questions and comments coming in. We will hold those questions until the end, but please feel free to throw those in throughout today's session. If you do have any questions or comments, again, feel free to throw that in the questions area, and we'll try to navigate those to the best of our ability during the session. And of course, we'll make sure they're answered after the session. We will have 4 polls today. So as they come up during our presentation, please take a moment to answer those polls. We need at least 3 completed for CPE credit. So again, there's 4 polls, but we only need 3 for credit. This recording will be made available on demand in a few days following the event. An email will be sent to you with that information. So for this session, we are joined by Victoria Daly and Tom Sawicki. So Victoria is a principal here with us, or here at Sikich with us, and carries about 15 years of experience in auditing in governmental entities, NFPs, and EVPs. Tom is a director here and also carries about 15 years of experience. He provides assurance services and recommendations for improvement on local government, manufacturing, and distribution clients. Thank you so much for joining us. I'll officially hand it over to Tom and Victoria.
All right, thanks, Rachel. Good afternoon, everyone. Thank you for joining us today, taking some of your time to be with us here. Again, my name is Tom Sawicki, director here at Sikich on our local government services team. Happy to be here with everybody today to continue our discussion on cash and investments. So last month we discussed and went through accounting for cash and investments, and today we'll kind of stay on topic and dive a little bit deeper into disclosures surrounding cash and investments. So thanks again for joining us. Nice to be with you here today. Also here today, as mentioned, is Victoria Daly, and I will turn it over to Victoria to introduce herself as well.
Thanks, Tom. Hi, my name is Victoria Daly, and like it was mentioned, I'm a principal with Sikich. I've been working as an auditor for state and local governments for almost 15 years, and I'm excited to present on the disclosures for cash and investments today. And we'll kick it off with our first polling question. So our polling questions are Halloween themed, so hopefully you enjoy them. And yeah, I'm excited for Halloween. So are my kids. So we'll give you a second to answer the poll and then we'll get started.
Would you rather read a spooky book or watch a spooky movie? I like this one. Yeah. Looks like movie is our winner. All right.
That's what I would pick too. Okay. All right, we'll start off. So accounting for cash and investments. So this section really helps to explain the requirements to disclose the various risks that governments might encounter with their cash and investment portfolios, what risks governments are really exposed to, and more importantly, what steps has your government taken to mitigate those risks. So that's really what the disclosures for cash and investments is all about. And this slide, you might recall from the very first slide in our session on accounting for cash and investments last month, I said cash and investments used to be one of the easiest things to account for, to disclose under the original guidance from the NCGA, the National Council on Governmental Accounting Statement Number 1, which was issued way back in 1979 before some of us were involved in the industry. So as you see on the slide, all we had to disclose related to what was probably the largest asset on our balance sheet, because this was before we had to report infrastructure. We had one line in our notes to the financial statements. We account for cash and investments at cost or amortized cost. And that was it. Now, we didn't really have any major changes to that guidance until GASB was formed. And then once GASB was formed, as we see on the next slide, they really just took off from a standard setting process. Right after GASB was formed, we had some issues in the overall cash and investment marketplace for state and local governments. We had the savings and loan crisis, which caused a lot of governments to lose some money that they had invested in savings and loans. We also had a securities firm that collapsed down in Florida called ESN Government Securities, and GASB reacted to those. And they issued GASB Statement Number 3 on deposits with financial institutions and investments, including repurchase agreements and reverse repurchase agreements. So when GASB came out with that, they told us, it was going to disclose everything that anyone wanted to know about the risk that your cash and investment portfolio was exposed to. Even though much of it is still in effect today, GASB followed up with Statement Number 3. Statement Number 3 with Statement Number 40, and then Statement Number 40 modified a lot of what was in the original GASB Number 3. So those two statements, GASB Statement 3 and GASB Statement 40, are really going to be the focus of our discussion today, because these really cover the deposit investment risk disclosures for state and local governments. Now we see more errors in the industry and understanding the application of these two pronouncements than probably any other pronouncement. And I think the reason for that is the disclosures related to cash and investments in our industry are so unique to our industry. We don't see these disclosures in the not-for-profit side or in the for-profit side or even in the international standard side. So it's really unique to state and local governments. And because of that, a lot of the auditors, a lot of service providers, whether they are banks or investment managers, they don't understand sometimes the complexity of our disclosures or the requirements of our disclosures, and therefore have problems complying with these disclosure requirements. So you see on the next slide, in addition to these 4 pronouncements that GASB has issued, we have a few others, such as GASB Statement Number 53 on accounting and financial reporting for derivative investments or derivative instruments and disclosures related to those. So we'll skip that because we find that very few governments have any type of derivatives in their investment portfolio. Then we have GASB Statement 72 on fair value measurements and applications, and GASB Statement 74 on financial reporting for post-employment benefit plans, which covers how we should account for investments of those plans, and GASB Statement 79 on certain external investment pools. And the last and most recent GASB on this slide is GASB Statement Number 93 on the replacement of interbank offered rates, which removed LIBOR as a benchmark rate used on many derivatives. On the next slide, we have GASB Interpretation Number 3 and a couple of GASB technical bulletins. GASB they don't issue technical bulletins and interpretations anymore. However, we still need to be aware of these because they are still applicable today. Now, these are a lot of standards that we have to cover, and many of you remember Fred Lance, who was retired from Sikich and is hopefully fishing right now, though it's a little chilly, but he would always recommend using the GASB codification to look something up. So if you're looking up the GASB codification in GARS, the Governmental Accounting Research System, you would go to section I-50 on investments, and it'll list all the requirements, all these pronouncements that we just had on your screen in one place. So we'll start with GASB number 3 on this slide. GASB Statement 3 was titled Deposits with Financial Institutions, Investments including repurchase agreements and reverse repurchase agreements. So this was issued back in April 1986, and it became effective for fiscal years ending December 31st, 1987 and thereafter. So this has been around for a long, long time. And GASB issued this primarily as a reaction to the ESM brokerage house collapse and the fact that governments lost money when they were invested in U.S. Treasury obligations, which many people may consider the safest investment in the world. And this is somewhat accurate as it is safe from a credit risk standpoint, but yet you can still invest in treasury obligations and lose all of your money if you don't focus on custodial credit risk as well. So we'll be talking about these particular risks today. GASB statement number 3 was intended to tell the users of our financial statements about all the risks that our portfolio might be exposed to. It really just gave us disclosures related to custodial credit risks for our bank balance of deposits as well as foreign investments. So if we take a look at the next slide, we'll go through that. So this is a sample disclosure that was required by GASB statement number 3. And as you see here, we had to disclose what the carrying amount of your bank balance of deposits was, as well as the bank balance of those deposits, and then categorize the bank balance into all 3 categories. So here was the carrying amount, here was the bank balance, and then we'd have to disclose based on the categories. And we had to disclose all 3 categories, even though, as you see here, all the deposits were just category 1. They didn't have any collateral that was in category 2 or category 3, but they still had to disclose that in a tabular format. And so this is right out of GASB statement number 3. This just disclosed the carrying amount, the bank balance of deposits with financial institutions, categorized to those 3 categories of risks. So the next slide, then we have the same information, the same kind of disclosures, but this time is for the investment side. We would have to disclose the carrying amount of the investments in a tabular format, and then the fair value of the investments if that was different than the carrying amount. And then we categorize them into 3 categories of what we call custodial credit risk over investments. And you can see only the U.S. government securities, the U.S. agency securities, and the municipal bonds were exposed to custodial credit risk. So we had to categorize these up here. And then certain other investments are not exposed to custodial credit risk, and those were just listed on a narrative format at the side of the table, which is what you see here for the insurance contracts, the Illinois Metropolitan Investment Trust, which is an investment money market fund, other mutual funds or money market accounts, and then the Illinois Funds Investment Pool, as this is just an example from an Illinois government, so any investment pools. On the next slide, we will see what GASB statement number 40 now has changed with that. So GASB statement number 40 was issued in March of 2003 and became effective for fiscal years beginning after June 15, 2004, or fiscal years ending June 30th, 2005 and thereafter. So this has been around for quite a few years now, but we still see a whole lot of errors in disclosures for this. At Sikich, we consider this to be a high-risk area for many governments, so we try to work closely with you in making sure that you understand what these risks are and that you have appropriate policies and procedures to safeguard against these risks. We also make sure you have good information in terms of documentation of your investment policy, documentation of custodial agreements, and documentation of your banking relationships to support what your risk might be regarding your particular portfolio. Now, one thing that GASB did in statement number 40 was they really focused on your policy and how your investment policy over cash and investments mitigates or doesn't mitigate some of these risks that we have now in this new standard. So what does GASB statement number 40 do for us? Well, as you can see on this slide, GASB statement number 40 pretty much modified the custodial credit risk disclosure for governments for both deposits with financial institutions as well as foreign investments. Statement 40 also eliminated what we call the window dressing requirement. So under statement number 3, the auditor had to look at not only what your classifications of custodial credit risk were at the end of the year, but also throughout the year to see if you're changing those classifications of custodial credit risk right near your fiscal year end to make everything look better at your end. What GASB statement 40 did though, is that it did add 5 additional disclosures for us now. So we have to disclose our policies for credit risk and how we mitigate credit risk, our policies on concentration of credit risk and whether or not we mitigate those, our policy on market risk, interest rate risk, and then foreign currency risk. So the first 4, I think, apply to many of us on the webinar today. The last one, the foreign currency risk, that one may not. So for foreign currency risk to apply, the investment itself would need to be denominated in a foreign currency, not a foreign bond that's denominated in the US currency, but instead a foreign bond or foreign investment that's denominated in the foreign currency. So that is when we have foreign currency risk, and that's how we can tell the difference between those two. GASB Statement 40 also came up with separate custodial credit risk disclosures for deposits with financial institutions and investments. So because of that, it's very important that you make sure you understand these separate components and that you have a policy that addresses those separate components. And sometimes we find that governments have really good policies, but then sometimes they get saved and filed somewhere, and you may forget to give it to your auditors, or you may forget to give it to the bank that you have your deposits with, or you forget to give it to the investment manager or investment advisor that's managing your portfolio for you. So sometimes we see violations in these policies because someone who's managing your portfolio is not getting a copy of that and not adhering to it. All Illinois and Missouri governments are required by statute to have an investment policy. Many have more than one, one for the municipality or government, one maybe for the pension plan, one for the OPEB plan, one for bond proceeds, for the bond ordinance. So you all should have one, and you should have a good one. So GFOA has some good examples on their website to look at. So make sure you have a good policy that addresses all of the risks we discussed, and that policy is distributed to those that should have a policy. You should also review the policy, make sure everything's current and relevant, and that your risk profile is still matched with how you're structuring the policy. Then, based on your review, revise if needed, and it's probably a good idea to review this annually and present the current investment policy to the governing board and then have them reaffirm the policy if there's no changes, or approve the revised policy. You should have a copy of the custodial agreement, the investment manager agreement, as well as the banking relationship agreement, and these should be retained at your government. So with that, let's see, we have the second polling question of the day. So I will give you a minute to enter that. Another fun Halloween themed question for you.
Yes, it looks like cats are bad luck this season.
Okay.
All
Stay away
right.
from cats. All right, we'll keep going. Okay, next we'll cover disclosures for cash and investments related to deposits. So first off, GASB Statement number 40 requires very different treatment from a disclosure standpoint versus a display standpoint. So we have to classify something referred to as a deposit with a financial institution in the notes, regardless of the fact that it might be displayed as an investment on the statement of net position. On the other hand, we might be disclosing an investment in our notes that is classified as cash and cash equivalents on the statement of net position. So those differences are intentional, and you don't need to worry about them. If you want to, you can break out those differences in the notes to reconcile them back to the statement of net position, but you don't have to. It's just important that the deposits and investments are covered by the required disclosures. Now you may ask, what is the difference between a deposit and an investment? And once again, this classification can be different in the notes. So starting with deposits, these are all deposits in a financial institution, specifically a bank, savings and loan, or credit union that are covered by FDIC. These can be demand deposits, such as savings accounts, a checking account, certain money market accounts. Now, sometimes money market accounts may not be covered by FDIC, so you should be careful with that one. Most nowadays are not deposit accounts. The second type of deposit is time deposits, such as certificates of deposits. But this one can be tricky as well because you need to understand the difference between a negotiable CD versus a non-negotiable CD. So we covered this in our webinar last month, but for those that weren't able to join us, I'll just go over the difference again, as this can be tricky. So non-negotiable CDs are those that you open from your local bank and you pay a certain percent, and they pay you a certain percent interest on the CD. So you cannot sell that CD on a secondary marketplace, and if you want to redeem it early, you have to contact the bank and then they'll give you your principal back and withhold some of the interest as a penalty. So that's a non-negotiable CD. Now, a negotiable CD, on the other hand, is a CD that you're generally going to buy from a broker, and a broker will buy a large block of these and divide them up and resell them to local governments or to investors. Now, these do have a secondary marketplace. You can sell it back to the broker or sell it to one of the broker's clients. So a negotiable CD has the characteristics of an investment because it has a secondary marketplace that you can sell the CD on, but it also has the characteristics of a deposit because if it's over $250,000, we need to look at custodial credit risk for categorizing the deposit as well as custodial credit risk for the investment. So negotiable CDs can be both a deposit and an investment for disclosure purposes. Non-negotiable CDs will always be classified as a deposit for disclosure purposes, even though it might be classified as an investment on the statement of net position. So once again, there is a difference, and there are differences in the display standpoint versus a disclosure standpoint. To summarize, deposits are all amounts in financial institutions covered by FDIC. Everything else then is an investment by default. So if it's not covered by FDIC, it's considered to be an investment. If it is covered by FDIC, it's classified as a deposit. So it's very important to understand this before we go any further. The second key item to understand is custodial credit risk. So what is custodial credit risk? A lot of people misunderstand what this risk is. Custodial credit risk is the risk that you would not be able to access your collateral securing your bank deposits or your investment securities if the counterparty to the transaction fails or the custodian fails. One example of custodial credit risk is the Bernie Madoff Ponzi scheme, which is one of the largest Ponzi schemes in the world. And so he stole all this money from investors, and it would have been caught a lot earlier if the regulators would have looked at his depository trust account and would have seen no investments held or owned by his firm. So he was telling people he was buying all these investments for them, but he was buying nothing. But because investors were letting the broker where they purchased the investment from also serve as a custodian, the holder of the investment, there was never a third party confirmation that what you paid for is actually what you bought and is being held for you. So all debt securities and equity securities are exposed to custodial credit risk. And we touched on this earlier, that U.S. Treasury obligations are considered to be one of the safest investments. But if you don't mitigate your exposure to custodial credit risk, you can still lose all the money you invested. Same thing for state and local government bonds, corporate, common and preferred stock, anything like that. On the other hand, if you think of Illinois funds or MOSIP, the Missouri State Investment Pool, or mutual funds, are those subject to custodial credit risk? And these are not, because there is no ownership in a specific security. So there is no custodial credit risk there. Instead, you own a piece or share of those securities within that pool. So because of that, there is no custodial credit risk when you invest in those types of mutual funds or money market funds or anything like that. The same guidance applies to collateral for this as well. So now we understand custodial credit risk and how to classify something as a deposit versus an investment. Now we will discuss disclosures. So preparing disclosures start with the summary of significant accounting policies. We need to define what is cash and cash equivalents. We need to define our investments, and we need to define what is an allowable investment for your investment policy and how those investments are valued. We are mainly focused on the primary government, but we could have separate disclosures for bond proceeds that have different requirements, or pension funds or OPEB funds that have investments, as well as for any discretely presented component units. If these all have different policies, these should all be disclosed separately in the financial statements. After the summary of significant accounting policies, next we will look at the cash and investments note disclosure. In the cash and cash equivalents note disclosure, you would disclose deposits with financial institutions. GASB Statement 40 requires deposits with financial institutions to be categorized into one of three categories, and we always categorize the bank balance of the deposits, not the carrying amount. So this is because if the FDIC is going to close a bank, they don't care what you say you have on your books. They only care about what the bank balance of the deposit is at the end of the day, and that is what is going to be compared to the FDIC insurance or collateral to determine what you can recover. So that's why we categorize by the bank balance and not the carrying value. And the best time to prepare an analysis of custodial credit risk is at month end when you are doing your bank reconciliations. So that's probably the best time to make sure your bank is complying with your investment policy, whether that's 100%, 110% coverage, or whatever your policy requires. So the first category, category 1, means the deposit is insured by the FDIC, or if uninsured, that is, it is collateralized with the government or the government's agent holding the collateral in the government's name. Insured means FDIC, which is generally $250,000 per depositor per insured bank. It may apply separately to interest-bearing and non-interest-bearing for banks in the same state as a depositor. And if you have any questions on applying FDIC, you can also go to fdic.gov and go to their EDI calculator, and this can tell you if you have any uninsured deposits and what steps to take. Also, a pass-through insurance may also be available for certain accounts. So, for example, primarily pension trust accounts. So this assumes that you get $250,000 for each participant in the pension plan for both active and retirees. But this calculation can become a little complex because you have to consider whether that participant has any of their own money in that bank. And if they do, then the $250,000 insurance gets reduced by the amount of their own money. And we also have CDARS and MaxSafe programs, which are ways of having additional FDIC allocated to the deposits in those programs. So how do we tell whose agent the custodian is acting as? Are they acting as the pledgors, the bank's agent, or the pledgees, the depositor's agent? So did you hire, some questions you can ask are, did you hire the custodian or did the bank? If you did, then they are probably acting as your agent. And if the bank hired the custodian, they are probably acting as the bank's agent who executed the custodial agreement. Another question to ask is, did you sign the custodial agreement or did the bank sign the custodial agreement? If you signed a collateral agreement with the bank, then most likely the custodian is acting as the bank's agent, not yours. And that's why a tri-party collateral agreement is recommended, which is executed all at the same time by the bank, the government, and the custodian, and specifies all parties' obligations in one document. Another important item to consider is you would want to receive confirmation of the collateral and investments held with the custodian and not the pledger or the counterparty, because you don't want to rely on that information from the bank because they are not the ones holding the collateral. The custodian is holding the collateral, and that's who you should confirm with to ensure that it's there held in the government's name. So what does held in the government's name mean? It would, so you would either have to be registered in the government's name, which is highly unlikely, or the more probable definition is a collateral is identified as being pledged to the pledgee and the custodian's underlying records. Now let's look at the other two categories. So the second category is uninsured collateral held by the pledging financial institution's trust department or its agent in the government's name. So this only applies to legally separate trust departments per federal banking laws, not the safekeeping department in the bank. The safekeeping department at the bank is just part of the makeup of the bank and not a legally separate entity. The agent of the pledger can also not be part of the same legal charter as the pledger bank. And the last category, or category 3, is uninsured collateral held by the pledger, but not by its agent or trust department in the government's name, or collateral held by anyone but not in the government's name, or just completely uncollateralized. So category 3 really has 3 subcategories to it, and deposits in category 3 are usually going to be or should be in violation of your investment policy. So for disclosure purposes, we combine categories 1 and 2 and use exception-based reporting. Basically, you just need to disclose what your policy is related to custodial credit risk, how you mitigate that risk, and what bank balances are in category 3, if there are any. If there are category 3 deposits, then you also need to disclose what subcategory of category 3 it is and if it's a violation of your investment policy. These generally only need to be in narrative format and do not need to be in the tabular format. And I'll show you an example of that in a minute. But before I do that, some other collateral issues are what types of collateral are allowed to be pledged. You can only pledge collateral that is an allowable investment by the investment policy or state statutes, because if the bank does fail, you may actually end up owning the investments that were collateralized. And you can't own investments that you're not legally allowed to invest in. A letter of credit can also be used, but understand that these are not investments. They're just allowable forms of collateral per state statutes. Make sure you have a copy of that letter of credit, because if the bank fails, you will need to go to the Federal Home Loan Bank, for example, or wherever, to cash that letter of credit in to recover your deposits. There's also collateral agreements and custody agreement examples available on gfoa.org under best practices. Single institution collateral pools are, for example, instead of the bank pledging 3 different securities to 3 different governments with a single institution collateral pool, they pledge all 3 of those to the pool to cover all uninsured deposits for all the bank deposits for state and local governments in their bank. And this can be okay and is allowable by state statutes, but because you can't verify that the collateral is sufficient to cover all the deposits, you'll want to make sure that you have an independent third party acting as an agent to the collateral pool. You also have multiple institution collateral pools, and we talked about custodians outsourcing the custodial function kind of in our example. And lastly, repurchase agreements are not collateral. These are an alternate method to secure uninsured deposits. They are allowed, but there are specific requirements that must be complied with. So make sure that you understand those specific requirements if you're using a repurchase agreement. And then on this slide, we have a sample disclosure of deposits with financial institutions. So we first define what custodial credit risk is. So custodial credit risk for deposits with financial institutions is risk that in the event of a bank's failure, the district's deposits may not be returned to it. We then disclose what the investment policy is. So it says that a district's investment policy requires pledging of collateral of all bank balances in excess of federal depository insurance with the collateral held by a third party in the district's name. And lastly, if there's any violation of the investment policy, or any Category 3 deposit, you would disclose that. So at December 31st, 2023, the district had $1,995,000 of uncollateralized deposits. So that last part is not an ideal disclosure because then it would be in violation of your investment policy. But just for showing this how it would look, would be the correct way to disclose it. So that brings us to our third polling question of the day. So we'll give you a minute to answer that, and then I will turn it over to Tom.
Okay. We're looking at pie. Pumpkin seems like the winner. I could see why.
Yeah. Apple's good too, but not during Halloween.
They can have apple pie in November.
Yeah.
All right, very good. Well, thanks, Victoria. Victoria went through a lot of information related to the deposit side of things. We're going to switch gears here for a bit and now go through some of the disclosures on the investment side of things now. So similar to what we have for deposits, we have three categories of custodial credit risk for investments. So category one here for investments are investments that are insured, registered, or held by the government or the government's agent in its name. But there are some very important differentiations to note here. First, very few investments can actually be considered to be registered, and very few governments have the ability to serve as custodian and actually hold an investment. We listed there Tennessee being one example with the Tennessee Valley Authority, but not very common there. What's ultimately important and what you need to understand is who does the Depository Trust Corporation identify as the owner. So that's DTC there. You might be more familiar with that acronym. So who does the final records actually identify as the owner of that particular investment? That's the key and ultimately what matters when it comes down to it. Now, when we look at insurance on the deposit side, we have FDIC coverage, and we can very clearly define what that FDIC coverage looks like, and you're all likely familiar with that. On the investment side, we have something a little bit different. We have the Securities Investors Protection Corporation, or SIPC. This provides $500,000 of total coverage, $400,000 of which is specific to investments, and then $100,000 is for cash related to broker dealers that are members of the SIPC. You can also have additional insurance on top of that as well, and this would be in the form of an excess SIPC policy. This provides similar coverage, but not quite the same as insurance for that. Excess SIPC insurance is insurance provided by a private insurer and not by the SIPC. The insurance is intended to protect brokerage customers against the risk that the customers will not recover all of their cash and securities under SIPA, which is the Securities Investor Protection Act. So again, comes back to understanding the differences between these different types of protections and safeguards that you can have in place as it relates to your investments. And then finally, U.S. Treasury and agency securities. These are actually not insured, which may not be what you think about those, as they're actually backed by the full faith and credit of the U.S. government, but that does not equate to actually being insured as defined by the standards. So again, just understanding that nuance there from an insurance standpoint for all of your investments. Next slide. So category two we have next. This is uninsured, unregistered investments that are held, held by a counterparty's trust department or the counterparty's agent in the government's name, with the counterparty being where the investment itself was purchased. You also want to note that most brokerage houses don't actually have that legally separate trust department, something that Victoria had mentioned earlier. They may have a holding department or some other variation of that, but not often will they have that separate trust department, just mainly due to the cost or the red tape they have to go through in order to set that up. So you don't often find that they have actually legally separate trust departments in practice. And then finally, we have category three. This relates to uninsured, unregistered investments held by the counterparty. in the government's name or held by anyone but not in the government's name there. So again, those are the increasing categorizations of risk as we look at custodial credit risk for investments, pretty similar conceptually to what we looked at for deposits, just some key differences there in those definitions. Next slide. Also within the standard, it did clarify that if a financial institution or broker-dealer acted as a purchasing agent by acquiring securities on behalf of an entity, that they are required to be considered a counterparty to that. And that's regardless of whether those securities are coming from the institution or broker-dealer's trading inventory or whether they are from the open market. So GASB told us that if they're functioning in this capacity and performing this specific role, then they have to be treated and viewed as a counterparty to that respective organization. Next slide. So looking again at the disclosure side of things here, very similar to deposits in that we're going to combine categories 1 and 2 for disclosure purposes here. Also, we'll have to continue to have exception-based disclosures here. And again, that's just requiring us to disclose those exceptions or deficiencies that we identify in those investments that you have. So if we have any investments that fall into category 3 classification, we will need to disclose those amounts. And then again, the subcategory of category 3 that they fall in. And again, generally, you'll have this in your footnotes presented in a narrative type format. Now, to be able to understand this and make these classifications and determine the correct categorization of your investments here, you have to make sure you have all the copies and agreements of all of your investment manager agreements, investment advisor agreements, any custodial agreements that are in effect, as well as any copies of excess SIPC policies, if you have those in place and used as security for your investments. So just want to make sure that you have current, accurate versions of those documents that you have in place, as that's really important to have when it comes to your deposit and investment risk disclosures, and then just for your overall knowledge of what's in place at your organization. Next slide. So here's a sample disclosure here for custodial credit risk. Custodial credit risk for investments is the risk that in the event of the failure of the counterparty to the investment, the village will not be able to recover the value of its investments that are in possession of an outside party. To limit its exposure, the village's investment policy requires all security transactions that are exposed to CCR to be processed on a delivery versus payment basis, with the underlying investments held by a third party acting as the village's agent, separate from where the investment was purchased, or by the trust department of the bank where purchased in the village's name. So just a sample disclosure there. So our note first identifies and defines what custodial credit risk for investments is. Next, it discusses about how the municipality has limited its exposure by requiring all security transactions that are exposed to CCR to be processed on a delivery versus payment basis or DVP basis. So DVP is a method that guarantees the transfer of securities only happens after payment has been made. DVP stipulates that the buyer's cash payment for securities must be made prior to or at the same time as delivery of the security. And then the footnote also notes that the municipality requires that the underlying investments are held by a third party acting as a village's agent, separate from where it was purchased, or to have it held by the trust department of the bank where purchased in the village's name. So again, that legally separate trust department is required here. So just understanding that the differentiation between a trust department versus a holding department or something similar along those lines, very important to note and to understand that difference. Next slide. So how do we actually go about preparing cash and investment disclosures here? For disclosures on the investment side, we first need to define what the allowable investments are based on the investment policy and based on the relevant statutory guidelines here. Those should be disclosed separately for the primary government and any component units. And then also if you have any major funds that have a different investment parameter, probably not very common, but if you do have that, make sure you're disclosing the allowable investments separately from the primary government there. Again, we're looking at exception-based reporting here, so any violations of the investment policy are required to be disclosed as part of the note disclosure. And then if you have any deposits or any bank balances in category 3, as we looked at earlier in our slides, those need to be footnoted as well. Next slide. So we had identified some specific risks earlier, and here on the investment side, we'll look at some of those disclosures you'll want to include surrounding those risks. So starting with credit risk. Credit risk, generally, you're going to be disclosing the ratings of the allowable investments that you have in your portfolio. Concentration of credit risk, you're going to disclose how much you can invest in any one type of investment. Interest rate risk, it's looking at the maturity length of your investments and how that's disclosed. And then finally, market risk covers the type of investments allowed. So if you have it in your policy where any of these risks are not specifically addressed, then you're going to need to disclose that as well. So if your policy, for example, does not address concentration of credit risk, you should have a note included within your investment note indicating that your entity's investment policy is silent on concentration of credit risk there. Next slide. So credit risk is the risk that the issuer of a debt security, a bond, for example, isn't going to be able to pay that amount upon maturity. So again, you'll need to disclose your policy as part of this. For example, if you're only going to, or you're only allowed to, whether by statutes or by your investment policy, invest in bonds in the top 4 rankings by a national ratings agency there, you want to make sure you disclose that. And then with that, with part of the disclosure, you'll disclose the credit ratings for your debt securities as well. First, this does not apply to U.S. government securities. So those are going to be your U.S. Treasury obligations or securities. Those are not subject to this disclosure. This also does not apply to government agency securities that are explicitly guaranteed by the government. But then we have the key differentiations here. If you have agency securities that are only implicitly guaranteed, then this disclosure, excuse me, this disclosure does apply to those. And then it's also applicable as well to corporate and state and local government bonds, if those are allowable both in your state and within your investment policy. So ultimately, credit risk should be disclosed by type of investment. And then if you have investments that are not rated, that must also be disclosed as well. Next slide. From a concentration of credit risk standpoint, you have to disclose any investments that are greater than 5% in any one issuer. So again, we have some exceptions here. Government securities, which are those U.S. Treasury obligations, do not apply, nor does it apply to any explicitly guaranteed agency securities. We also do not have this applying to mutual funds, external investment pools, and other pooled investments as part of the disclosures here. However, if it's part of your investment policy, you can include that disclosure as a voluntary disclosure if you choose. And frankly, it should be part of your investment policy as well. And also, I'll just say, just because it's not greater than 5% of your portfolio doesn't necessarily mean there's still not risk associated with those particular amounts and how you're disclosing those and structuring your portfolio. So there may not be a required disclosure or risk noted for the standards, but still important to monitor at your organization. Next slide. So here's an example of a disclosure of credit risk and concentration of credit risk. So credit risk being the top piece up there. The village limits its exposure to credit risk, the risk that the issuer of a debt security will not pay its par value upon maturity, by primarily investing in investment pools and money market funds. However, the investment policy does not specifically address credit risk, except for municipal bonds, which must be rated in the 4 highest categories by a national rating agency. The money market funds, Illinois funds, and IMET are rated AAA and AA, and the municipal bonds are rated AA1 to AA+. So with this, we're identifying the definition of credit risk, how the village mitigates that risk, and then the appropriate ratings where applicable. Then below that, we have our concentration of credit risk disclosure. The village did not have greater than 5% of the overall portfolio in a single investment other than money market funds. The village's investment policy does not limit the amount of the portfolio that can be invested in any one investment vehicle. And so here we would note any single individual investment that's greater than 5% of the overall portfolio, and then how the investment policy does or does not limit concentration. Determining how much your municipality would limit or not limit concentration really boils down to your overall risk tolerance, how you choose to structure your investment portfolio. And that's going to be done through, internal discussions, direction from the board, any external market factors, things like that. Next slide. So interest rate risk is very important when the market goes through highly volatile periods. So it should be front of mind for all of us in terms of looking at our policies and how we're disclosing things related to our policies here. So interest rate risk is the risk of a decline in the fair value of a debt security based on changing interest rates in the market, as well as the length of maturity of the debt security. This also applies to debt mutual funds, debt money markets, and investment pools, unless the fund is maintaining a $1 per share net asset value. So basically, any debt-backed security is going to fall under the interest rate risk categorization and disclosure here. So we're required to disclose these in one of 5 different ways. So the 5 different methods here are provided, the most common being the first there, segment and time distribution. We also have allowable disclosures for specific identification, weighted average, duration, and simulation model. And you also need to disclose these based on the underlying maturities held by the mutual funds, money market funds, and investment pools as well. Next slide. So you want to choose the method that you're going to use to identify and manage interest rate risk. So again, here are the 5 options presented we just went through, and we're going to go through a quick example of each of these on the next slides to kind of show you what disclosure options that you do have. Next slide. First, we have specific identification. Specific identification does not compute a disclosure measure, but rather presents a list of each investment, its amount, maturity date, and any call options available. So very simply put, it's just listing each investment that you have with its maturity separately identified. However, if you have a very, very large investment portfolio, this can become a very cumbersome disclosure, and for that reason, you don't really see it that often. On the next slide here, we have a very basic example of interest rate risk using specific identification. You can see that each specific investment is listed out along with its maturity date as well as its fair value. Additionally, we would mention any call options here. Again, if you have a large portfolio, you can imagine how kind of large and overbearing and frankly unnecessary this disclosure can become. In this example, it's pretty straightforward. There's just a few on hand, but if you have a lot more, can be a little bit too much information there. So next slide. The next type of interest rate risk is the segmented time distribution. It's kind of like a laddering method from a presentation standpoint. Segmented time distribution provides various categories and amounts that fall into those categories. These aren't predefined, but by example here, you can have investments that are less than 1 year, 1 to 5, 6 to 10, and then 10 plus. That's probably the most common that we do see in practice. And then on the next slide, we have an example here. This is actually from GFOA. So from an investment type standpoint, on the far left side, they presented several types of investments in the disclosure here. They have for purchase agreements, treasuries, agencies, commercial paper, corporate bonds, mutual bond funds, and bankers' acceptances. Next column over presents fair value of those investments, and you'll see the various categorizations and maturities of those investments in those years that you've broken out. So ultimately, you list out your types of investment security categories, break them out into each of those buckets depending on when it matures, and then ultimately come into a total for that category. So from a presentation standpoint, probably the easiest to visualize when investments are maturing in the future. Also, this is important in order to be able to appropriately plan out your investment portfolio and make sure it falls in line with your investment policy. Next slide. So really quickly here before I go to the next type of interest rate risk disclosure, here's a sample disclosure in your footnotes. In accordance with its investment policy, the village limits its exposure to interest rate risk by structuring the portfolio to provide liquidity for operating funds and maximizing yields for funds not needed within a 2-year period. The investment policy limits the maximum maturity length of the investments in the operating funds to 2 years from date of purchase. Reserve funds may be invested longer if tied to a specific cash flow need. In addition, the policy requires Village to structure the investment portfolio so that securities mature to meet cash requirements for ongoing operations, thereby avoiding the need to sell securities in the open market prior to maturity. So a good example of how the Village's policy addresses this risk, and then what the Village does in order to mitigate its exposure to this risk. So in this case, doing this in a manner by providing liquidity for operating funds to maximize yields within 2 years. If they have any reserve funds or investing, those could be longer, but need to tie them to a specific cash flow need. And then the last section discussing the ongoing cash requirements there. So being able to structure your portfolio, this allows, and then ultimately the intent of this is so the Village, in this case, does not have to go back to the open market and sell securities prior to maturity, and then risk out on losing a portion of that investment by going to having to go to the market earlier than anticipated. So conceptually, if you think about cashing in a CD early to meet cash flow needs, you'd like to avoid that in order to maximize how much interest you can earn as part of that transaction, and then again, also not potentially having a penalty associated with that. Next slide. So jumping back into our types here, we have weighted average maturity method. Under this method, you're going to calculate the WAM for each investment based on the years of maturity multiplied by the maturity amount as percentage of the total portfolio. And then your weighted average is then added together from each investment to come to your total weighted average. And then on the next slide, here's our example, again from GFOA. You can see the various investment categories. And the Village would have calculated each of the weighted averages for these categories based on the maturities and the allocation of those investments in comparison to the portfolio as a whole. So from a presentation standpoint, this is also easy to conceptualize in terms of when the investments are maturing in the future, just has a little bit less detail than the segmented time distribution. On the next slide here, we have the duration method. Duration method similar to weighted average, except the major difference being you're going to go through and just adjust those for the present value of those investments. On the next slide, we have the example of the duration method. Looks pretty similar to the weighted average maturity, but again, this is discounted back to the present value. I feel it's going to be a little bit misleading just because if you're looking at the overall ending weighted average maturity or duration for the portfolio in total, it may not necessarily take into account, some of those lower values there. So for example, US agencies only has about 23,000, but has a longer duration, but doesn't really impact that overall duration for the total portfolio. So you can somewhat gloss over or neglect some of those maturities in your portfolio that don't have large values. So really need to look at it on a category by category basis as well as in total. And then the final category here on the next slide is the simulation model. Simulation model estimates changes in the investments or portfolio's fair value given hypothetical changes in interest rates. So these would be sort of what we consider what if type calculations. So our example on the next slide here takes a look at how the investment portfolio would fluctuate based on changes in the markets. You can think of this pretty similar to our actuary calculations when we look at our sensitivity of discount rates and how the NPL can fluctuate significantly. Kind of the same point here, looking at how the investment portfolio would fluctuate with changes in the basis points of your investment returns. So maybe not totally useful on its own, but could have some merit to disclose in addition to some of the other methods here. So again, not very common, but typically we'd see the segmented time distribution as the most common disclosure. Next slide. If you have any additional contractual terms that could increase or modify your exposure to interest rate risks, you're required to note those as well. Next slide. So our last polling question.
Last poll. Out of which vegetable were jack-o'-lanterns originally made? It's a good one. Okay. I'm going to close the poll. And the correct answer is a turnip. to you.
All right, thank you. And then our last risk here is foreign currency risk. Victoria touched on this earlier. If you have any investments denominated in a currency other than US dollars, you're required to disclose those values and those amounts related to those investments in US dollars. Just to clarify with a quick example here from the implementation guide, the question was if a government has an investment in an international mutual fund that's denominated in US dollars, the fund invests in securities that do not trade in the United States and hence are not denominated in US dollars. Is foreign currency risk disclosure required? The answer is no, because investment in US is and the fund is in US dollar denominated, so it does not require us to look through to the individual investments held by the fund. So no foreign currency risk disclosure required there. So again, probably not too common or frequent of a situation that arises for our clients out there, but just something to note if you do have any foreign currency investments. So and then the last slides we have here, looks like we're up against time. Again, going into derivatives, I don't believe we really have a lot of these in practice. So if you do have any questions on disclosures for derivatives, happy to address those. But given time here, I think we'll kind of end the presentation here. Again, I'd like to thank everybody for your time here today. If you have any questions or need any clarifications on anything, please let us know. We'd be happy to address those. Our contact information is listed there. And with that, I will turn it back over to Rachel.
All right, thank you so much, Tom and Victoria, for taking the time to talk with us today, and thank you to everyone who's on with us. Make sure you download those materials before you log off today, and have a wonderful rest of your day. Thank you.
Thanks, everyone.